Friends, welcome back to our channel OMSAI Bhojanapalli.
Good morning, friends. So we are doing the chapter portfolio management. In that, we are doing the area levered beta, unlevered beta and proxy beta. Today we will complete few more sums left out in this topic: levered beta, unlevered beta and proxy beta. Once we complete that, we will go for the next slot called as short single index model. Very important concept like CAPM. Recently in the exams, it has been very regularly asked. Once we complete short, we will be left only with the arbitrage pricing theory to cover in this chapter, portfolio management. Let us summarize what has been done from CAPM onwards, not from the beginning. Okay, what has been discussed before I continue with the levered beta, unlevered beta concept. So we saw that this chapter is all about understanding what should be the discount rate that should be used to value the assets. Discount rate in turn depends on the risk. CAPM classifies risk into two types: systematic and then unsystematic risk. Systematic risk is inherent in the system itself, which cannot be avoided through diversification. Unsystematic risk is company specific, can be avoided through diversification. CAPM says that a person should ask risk premium only for the systematic risk, should not ask a premium for the unsystematic risk. So here he had a SML equation: KE is equal to RF plus beta into RM minus RF. Any person requires a minimum return called as risk-free return, plus he wants a risk premium. For taking the market portfolio's risk, he wants a premium of RM minus RF. For taking a given security risk, he wants a premium of beta times RM minus RF. What is beta? Beta measures the change in security return in relation to the change in market return. We can calculate beta in 6 methods, in which we have discussed 3 methods for calculating the beta. Next 3 methods we will discuss in the short single index model. Beta is equal to change in security return divided by change in market return, or it is standard deviation of security by standard deviation of market into correlation of security and market. Third, it is covariance of security and market divided by sigma m the whole square. So here we saw that the difference between CML and SML is that in capital market line we ask the risk premium for the entire risk, but here we ask the risk premium only for the systematic risk. It is not sigma S by sigma M, it is sigma S by sigma M into correlation of S and M. That means only that portion of the standard deviation of security which is correlated to market will be asked as a premium for risk. Then we saw that using this KE, one can price an asset. Value the asset using this KE. That asset value we call as fair price or equilibrium price. Then you compare that with the actual price. If the actual price is more, say the asset is overpriced. Actual price is less, say the asset is underpriced. Overpriced asset should be sold. Underpriced asset should be purchased. And this is the underpricing or overpricing. Another way of understanding it, find out the expected return from the asset and compare with this SML return. If expected return is more than SML return, that means asset is expected to give more return than what I want for the given level of risk. That is a good asset to buy. If the expected return is less than the SML return, the asset should not be purchased. So expected return minus SML return is called as alpha. Positive alpha stock should be purchased. They are underpriced. Negative alpha stock should not be purchased. They are overpriced. This is what we discuss in the CAPM. Then we discuss about the concept of portfolio beta. Beta of a portfolio is the weighted average beta of the individual securities inside the portfolio. It is not like a standard deviation of a portfolio where we have the correlation coefficients. The reason is beta itself has got a correlation coefficient that is correlated with the market. More about this correlation with market, individual correlations, all this will be discussing in this area called a sharp single index model, where more mathematically, more statistically, one will be understanding the full concept of beta. Okay, next. Once this is covered, we discuss about the concept of levered beta and then unlevered beta. Beta represents risk. How much the security return changes for the change in the market scenario is what we call as the beta. Now, beta risk can come from two things. One is from the as a business risk, another from the financial risk. Businesses can be influenced by two factors. One is the nature of product and services, and number two is the cost structure of the company, where it can use more fixed cost. If the product is more discretionary, then a small change up and down in the market will greatly influence the sales of the company. That too, if the company is doing the business with heavy fixed cost, the change in sales will affect the change in EBIT very much. Financial side, if you borrow and do the business, then will be having a much more impact of EBIT change on the EPS. First is called as operating leverage, second is called as financial leverage. Hence we saw that the beta of a company can be classified into two, the beta of a debt and beta of the equity. Asset beta is the source beta, the destination beta is beta of debt and beta of equity. Debt beta is assumed to be 0 and the equity beta only is going to be bearing the entire asset beta. If the company is levered, then the equity shareholders beta is called as levered beta. If the company is unlevered, the equity shareholders beta is called as unlevered beta. There exists a relationship between levered beta and unlevered beta. Above that only we derive the formula discussed here. The beta of a levered company without tax. Tell me, beta levered is equal to beta unlevered into debt plus equity divided by equity. With tax, beta levered is equal to beta unlevered into debt into 1 minus t plus equity divided by equity. When you have say unlevered beta, the formula should be reversed. That's all. Then why we should study levered beta or unlevered beta? Question arises mainly to discuss about the concept called as proxy beta. Sometimes company cannot use its own beta to find out the asset values or to find out the project discounted etc. due to the following reasons. Number one, a company going for an IPO. First time it is going for a public issue. In that case, it does not have a track record of its prices with the market because the shares are now only going to be traded. In such case, company can take beta of another company which is in the same business. Similarly, company which is going for a new project, the project is totally unrelated to their existing business. In that case, the company's existing beta cannot be taken because that represents a different business risk. In those cases, we can take the beta of another company. When we take the beta of another company, two things should be kept in mind. Number one, we should take only the unlevered beta. We should not take the levered beta because their debt equity mix and our debt equity mix may change. So we have to capture only the unlevered beta or the business risk angle alone. The two, though if the company, other company is having a portfolio of businesses, only take the related business unlevered beta and not the full unlevered beta. This is what we discussed in the proxy beta. Respond yes or no. We did one institute RTP problem, a very good problem where we made a project selection based on the CAPM in which a proxy beta was used. Up to this we completed the last class. Right on. See, from CAPM itself so much was summarized. Yes or no? That's not summarizing from the first, the risk return profile. It takes very long to summarize. Just to understand that how much has been covered in this chapter, such a big chapter or voluminous chapter. Please have a consistent revision process because all this you will forget. Even with notes you may forget if you don't revise consistently. Can I proceed or not? No. Let us do a few more problems in this proxy beta and levered beta, unlevered beta area. Then we can just move on to the next stage. Okay, now. Take question number 37. Take question. I think last problem it is question number 36. Right, Abba? My question is 36 completed. Okay. Take question number 37. Any notes given for question number 36? Okay. I'll complete question number 37 and then give a notes for 36 and 37. Please. Please. Messrs. V Steels Limited is planning for a diversification project in automobile sector. Its current equity beta is 1.2. Whereas the automobile sector has 1.6. Gearing of automobile sector is 30% debt and 70% equity. If expected market return is 25%, what is 25%? RM. Risk-free debt is 10%, RF. And the taxation rate is taken as 30%, and also the corporate debt is assumed to be risk-free. Compute suitable discount rate under the following situations. Project financed by equity only, by 30% debt, 70% equity, by 40% debt and 60% equity. That's our question. Nothing new we are going to learn here. Just only a practice problem we're going to do in this proxy beta. Just we'll do this problem and then go for the next one. Okay. Now, we don't have the slide for the sum. We'll be doing the sum together. Can we start or not? Now, first, tell me, V Steels is now in which business? Name here, it is in steel. Tata Steel is doing what business? Yeah, steel business. Yeah, so no. Now, V Steels in which business? Steel business. It wants to diversify into what sector? Automobile sector. Now, the current beta of this steel, V Steels is 1.2. Can this 1.2 be considered? Cannot be considered. Cannot be considered. Why? It represents a steel's business risk and not the automobile sector risk. Yes or no? That means I take the automobile sector beta. Okay. Even in the stock market, beta of the sector itself is what? Published. You need not take pains to calculate the beta of the sector. It is published. So the automobile sector beta is how many times here? 1.6 times. But the sector is geared. Sector gearing means if I add all the companies liability side and see the debt equity ratio, you will get the gearing of the entire sector, automobile sector. The gearing of the sector is given as how much percent debt and equity? 30% debt and 70% equity. Now, we want RM as, RM is 25%, RF is 10%, taxation is 30%. Now, our project is going to be financed. How it is going to be financed here? By equity only. First question, by 30% debt, 70% equity. Second question, third question, 40% debt, 60% equity. For all this, they ask you to calculate WACC. They ask you to calculate what? The discount rate means weighted average cost of capital. To calculate WACC, we should know what? KE. To know KE, you should know what? Beta. So the beta should be the proxy beta that should be taken is the issue. Everybody, can I start or not? No. We'll do the sum together. Can we start or not? Write down first. Part 1. Write down part 1. First of all, are you all able to hear me clearly? Clarity is there or not? Okay, part 1, please. Question number 37. Part 1. Project is financed 100% by equity. Part 1. Project is financed 100% by equity. Part 1. Project is financed 100% by equity. Project is financed 100% by equity. Can you start or not? Now, first of all, my question is, The automobile sector beta is 1.6 times. Yes or no? Can I take that 1.6 as a beta for my project or not? No. Why I cannot take? It is levered. I should take only the unlevered beta. We have to unlever it. Yes or no? Now write down in that. Step 1. Step 1. Beta U. Beta U means what? Beta unlevered. Beta U of automobile sector. Step 1. Beta unlevered of automobile sector. Beta unlevered of automobile sector. Can I start or not? Now write the formula. Beta unlevered is equal to, tell the formula and then write beta levered into equity divided by debt into 1 minus t plus equity. Equity divided by debt into 1 minus t plus equity. What is the gearing ratio given? Please tell me. 30% debt, 70% equity. That's right. Next line. D is to E. Debt is to equity. What did it equity? 0.30 is to 0.70. 0.30 is to 0.70. 30% debt and then what? 70% equity. 0.30 is to 0.70. Respond. Can I proceed or not? Now. Continue writing. Beta unlevered is equal to, what is the levered beta automobile sector? 1.6 into equity by, what is equity? 0.70 by debt into 1 minus t is what? 0.30 into 1 minus 0.30 plus what? 0.70. 0.70 divided by 0.3 into 1 minus 0.3 plus 0.70 into 1.6. Tell me the number I am going to get. 1.23 times is the beta of the automobile sector, unlevered beta of the automobile sector. This represents what? Automobile sector risk. Can I proceed or not? Next. Step 1 or step 2 or step 2. Calculation of KE. Step 2. Calculation of KE. Calculation of KE. My question is, in part 1, I am going to finance my new project using debt equity ratio or only equity. Only equity. For a 100% equity company, its beta is unlevered beta. It does not have a financial risk. It's got only the business risk. Asset beta is equal to unlevered beta. Am I right or not? So write down. Next. Since it is 100% equity, comma, the equity beta is unlevered beta. Since it is 100% equity, the equity beta is unlevered beta. The equity beta is unlevered beta. Write down. KE is equal to, always write the formula and substitute. K is equal to RF plus beta into RM minus RF. K is equal to RF plus beta into RM minus RF. RF plus beta into RM minus RF. Can I substitute the number or not? Now, tell me what is the risk-free rate given? 10%. 10% plus beta into, what is beta we have? 1.23. You know only calculated na? 1.23 into, what is RM? 25% minus 10%. 10% plus 1.23 into 25% minus 10%. Can somebody tell me the number here? 28.45 percentage. 28.45 percentage. It is 28.45 percentage. Respond yes or no. Now, this is KE. I want to know what is WACC. What is weighted average cost of capital? KE. Because there is no debt. Right now, continue. Since it is all equity company, WACC is equal to KE. since it is all equity company, WACC, weighted average cost of capital, WACC is equal to KE, is equal to 28.45%. WACC is equal to KE is equal to 28.45%. WACC is equal to KE is equal to 28.45%. Everybody, can I proceed or not? Now, with this we completed the part 1. What is part 1? All equity, that is 100% equity. Now, write down next part 2. Next, write part 2. Project financed by, give the heading, part 2. Project financed by, tell me, project financed by 30% debt and 70% equity. Project financed by 30% debt and 70% equity. Project financed by 30% debt and 70% equity. My question is, can I take 1.6 automobile sector beat as my beat or not? Yes. Why can take? Sector also is having the same debt equity ratio. I am also having what? Same debt equity ratio. If I unlever it and relever it, I will be getting the same number. Yes or no? Can I proceed? Write down. Since the debt equity ratio is same, since the debt equity ratio is the same for the project and automobile sector, since the debt equity ratio is the same for the project and automobile sector, since the debt equity ratio is the same for the project and automobile sector, we can take the sector beta straight away. We can take the sector beta straight away as proxy beta. We can take sector beta straight away as proxy beta. We can take sector beta straight away as proxy beta. Everybody, can I proceed or not? Next, step 1. Calculation of KE. Now we are going to have 2 steps, KE calculation, and next step is what? WACC calculation. Understood or not? Now, step 1, calculation of KE. First of all, good morning friends. Good morning, sir. Are you understanding the flow and writing or not? Now, calculation of sector, the calculation of KE. Calculation of KE. Write the formula. KE is equal to RF plus beta into RM minus RF. K is equal to RF plus beta into RM minus RF. What is RF having? 10% plus. What is beta having? 1.6 into what is RM? 25% minus 10%. Is it how much percentage here? 34%. 34%. KE is equal to 34%. K is equal to 34%. Respond. Can I proceed or not? Next. Step 2. Calculation of WACC. Step 2. Calculation of WACC. Weighted average cost of capital. Calculation of WACC. Weighted average cost of capital. Can I start up? Now, what are all the columns here? First is what? Source. Second column, proportion. Third column is cost. Last column is weighted cost. Source, proportion, cost, and then weighted cost. Can we start or not? What are you writing along with me? What are 2 sources of finance? Equity and then debt. Equity and then debt. I think proportion of equity is how much here? 0.3 is to 0.7 or 0.7. Equity proportion is 0.7. Debt proportion is 0.3. Debt proportion is 0.3. Tell me, what is cost of equity? 34%. Cost of equity is 34%. Now, debt don't take 10%. It is going to have what? A tax shield. Yes or no? So it is I into 1 minus T percentage or not? Now, in the case the debt is going to be 10% into 1 minus 0.30 tax of 30%. 10% into 1 minus 0.30 is equal to, tell me the number here. is equal to how much percent? 7%. Debt is equal to 7%. Debt is equal to 7%. Weighted cost 0.7 into 34, somebody? 23.8 percentage. 0.3 into 7, I will tell 2.1 percentage. What total here? 25.9 percentage, which we normally call as WACC. Even people call us what? KO. Overall cost of capital or weighted average cost of capital. Don't think WACC divided by KO. Illappa, WACC or what? KO is what has been written. Everybody, yes or no? No. Part 2 has been over. This should be the discounted I should be using when I find out NPV of the project, when I use 30 and 70 debt equity ratio. Right or not? Next. Part 3, the last part, right? Part 3. Okay. 40% debt and then what? 60% equity. Can I start or not? First, can I take the sector beta as it is? No. It is having a different leverage. I am having a different leverage. Unleverage, releverage, and then calculate KE, and then calculate the WACC. Everybody following or not? Right on. First, step 1. Before that, part 3, give the heading, project financed by. Part 3, give the heading, project financed by 40% debt and 60% equity. Project financed by 40% debt and 60% equity. 40% debt and 60% equity. Shall I proceed above? Now. Step 1. Calculation of unlevered beta. I know it, yeah. Calculation of unlevered beta. Let's have that step. Okay, step 1. Calculation of unlevered beta. Right on. Beta u is equal to, we already calculated na. Beta u is equal to how much you calculated? 1.23 times. Beta u is equal to 1.23 times. Bracket le refer part 1 calculation. Beta u is equal to 1.23 times. Refer part 1 calculation. Part 1 calculation. Step 2. Converting it back to levered beta. Step 2. Converting it back to levered beta. Converting it back to levered beta. Can I proceed? Now, write the formula. Beta levered is equal to, what is the formula? Beta unlevered into debt into 1 minus t plus equity divided by equity. Debt into 1 minus t plus equity divided by equity. Can you proceed or not? Now, what is debt is to equity, right? What is the debt ratio for the project? 0.4, 0.6. 0.4 is to 0.6. 0.4 is to 0.6. Can I proceed now? Write on. Beta levered is equal to, what is unlevered beta? 1.23 into 0.4 into 1 minus 0.3 plus 0.6 divided by 0.6. 0.4 into 1 minus 0.3 plus 0.6 divided by 0.6. Can you tell how many times here? 1.8? Or 1.80 times. Tell me why it has increased here. Debt equity ratio has changed. So it become 1.80 times. Can I proceed or not? Next. Step 2 or step 3 or step 3. Calculation of KE. Step 3. Calculation of KE. Underline that. Calculation of KE. Underline that. Write the formula and then substitute. KE is equal to RF plus beta into RM minus RF. KE is equal to RF plus beta into RM minus RF, which is equal to, what is RF? Tell me. 10% plus, what is beta? 1.8 into what is RM? 25% minus 10%. 10 plus 1.8 into 25 minus 10. 37%. K is equal to 37%. Everybody, can I proceed or not? Okay, next. Step 3 or step 4? Step 4. Calculation of WACC. Step 4. Calculation of WACC. Weighted average cost of capital. Calculation of WACC. Tell me the columns. What are the columns here? Source. Next is what? The proportion. Third is cost. Last is weighted cost. Source, proportion, cost, and then weighted cost. What are the two sources of finance? Equity and then debt. Proportion is 0.60. Right. Next is what? 0.40. 0.60, 0.40. What are the cost here? 37%. Right or not? Now, it is going to be 10 into 1 minus 0.37%, 7%. 37% and 7%. 0.6 into 37% gives you, remember, 22.2 percentage, and this becomes 2.8 percentage. How much percentage? 25 percentage is called as what? WACC or KO in this case. Everybody following or not? Now, a standard problem, a past examination question also. Everybody having the clarity or not? Now, this is regarding solution to question number 37, where we discuss about levered beta, unlevered beta, and then proxy beta. Respond, yes or no? No. Question number 38, I'll give it as homework. Reason is, it is very similar to question number 37, but I will give it as homework. Okay, now, let's have a small notes regarding the proxy beta and then go for the remaining small problem left in the levered beta and unlevered beta. Complete them in another 15 minutes before you go for the next stage. Okay, write down notes. Notes. Heading given as concept of proxy beta. Concept of proxy beta. Concept of proxy beta. Point number 1. Sometimes company cannot use its own beta. Sometimes company cannot use its own beta for share valuation, or company cannot use its own beta for share valuation or project selection. Sometimes company cannot use its own beta for share valuation or project selection. Bracket reasons discussed earlier. Bracket right? Reasons discussed earlier. If you remember, when I discussed levered, unlevered, I gave you the notes. What are the two reasons? Tell me here. IPO for share valuation. Another is what? Unrelated project for discount rate. I think you all remember or not? So, reason discussed earlier. Bracket close. Point number 2. In such case, it will use beta of, other companies. In such case, it will use beta of other companies, which is called, it will use beta of other companies. It is called what? Proxy beta. It will use beta of other companies. It is called proxy beta. Point number 2 or 3? 3. While taking proxy beta, the following points should be kept in mind. While taking proxy beta, the following points should be kept in mind. While taking proxy beta, the following points should be kept in mind. The following points should be kept in mind. The right point A. Right A. We should only take we should only take the asset beta or unlevered beta. Asset beta, unlevered beta same, yes or no? We should only take the asset beta or unlevered beta of the other company. We should only take the asset beta or unlevered beta of the other company because that only purely represents the business risk. Because that only purely represents the business risk. Point number A was point A. Everybody following or not? Next. Point B. Even the unlevered or asset beta taken, should pertain to what? Related business. Even the unlevered or asset beta taken should pertain to related business. Point B is here C. To even out extremes, comma, the company should take proxy beta of more than one company. The company should take proxy beta of more than one company in that related business. The company should take proxy beta of more than one company in the related business and average it out. Everybody, are you comfortable or not? Now, this is regarding the care that should be taken for calculating the proxy beta. With this, we complete the small slot called as what? Proxy beta. Can I proceed further or not? Few more sums here and there is there for levered, unlevered beta. Let us quickly complete it in another 15 minutes before we go for the next stage of discussion. Can I proceed now? Next. Take question number 30. Please. Stop talking. Take question number 30. Small sums. There in the study material as well as practice manual. Pause examination questions. Just to get the feel of the problems. That's all. Okay. Take question number 30. Please. Amit company's equity beta is 1.3. Its debt equity ratio is 1.5. Answer my question. Equity shareholder of this Amit company will be having business risk or financial risk or both. So he will be having a risk of both. So the equity beta given for the company will be levered or unlevered beta? Levered beta. Correct? Very simple. If you are a shareholder in a All equity company, your beta is what? Unlevered beta. That is, your beta is only the asset beta. But if you are a shareholder in what? Levered company, your beta is not only the asset beta, unlevered beta, you also have what? A financial risk. If you add the financial risk, it becomes what? A levered beta. Innapa, right or not? Now, see, the source beta is not going to change. But instead of so many shareholders sharing that beta, a debt provider will not take his risk. His risk also be taken by what? The equity shareholder. The leverage it makes much more higher in case of levered beta. Yes or no? Now, come back. Amit company's equity beta is 1.3. I want an answer. Levered, unlevered, levered beta. His debt equity ratio is 1.5 means 1.5 is to 1. One should be understanding it. Tax rate is tax rate is 30%. What is Amit company's asset beta? See, every levered company will also have an asset beta. Every levered company will be having an asset beta, unlevered beta, because the source beta. There's going to be what? Source beta. The source beta gets magnified. It gets what? Magnified due to use of what? Leverage. Yes or no? Yes, sir. Should I explain once again? Can I proceed? Class by mark, explain, can I proceed? Jokes apart. Those who want me to explain once again, raise your hand. Okay, I'll explain. Please. Shh. See, you are a shareholder of an unlevered company. That means there are two companies here, A Limited and then what? B Limited. A Limited is all equity company. B Limited is what? A company that has borrowed. Both companies doing the same business. Everything is same except for what? Capital structure. Understand not? No. You are a shareholder of A Limited. Shareholder of what? A Limited. All equity company. Your beta is what beta? Unlevered beta. Your beta is asset beta. Kadapa. Asset beta is the beta coming from the business risk. That becomes what? Beta of the equity shareholder. Since you are a shareholder of what? Unlevered company, your equity beta I call as what? Unlevered beta. Yes or no? Okay. So asset beta is equal to unlevered beta is equal to your beta there. Yes or no? No. Suppose you are the shareholder of not an unlevered company, but what? A levered company. In that case, you will have an asset beta or not? Yes, you will have what? Asset beta. It is same as the previous company beta, yes or no? But the shareholder beta is not only asset beta because he is having what? A debt risk also. What I am saying? In that case, his beta becomes what? Magnified using the leverage. In that case, your beta becomes what beta? Levered beta. The levered beta is nothing but the unlevered beta, asset beta into debt plus equity divided by equity. Right or not? Understand one thing, whether it is levered company or unlevered company, the source beta is what? Asset beta. And that asset beta itself is what? Equity beta. For an unlevered company, the asset beta gets what? Magnified using debt equity mix for a levered company is the ultimate conclusion. Right or not? Can I proceed further? No. Now they ask you to calculate what? Asset beta. Tell me what is the other name for asset beta? Unlevered beta. Can I proceed or not? Write down. Question number 30. Question number 30. Okay, first, beta of asset. Beta of asset. One in bracket, right? It is what? Unlevered beta. There's nothing wrong if you write as unlevered beta. This will be the beta if the company is all equity. Beta of asset or unlevered beta is equal to what the formula? Beta levered into tax is there or not? Yes. Into equity divided by debt into 1 minus t plus equity. Into equity divided by debt into 1 minus t plus equity. Can I proceed above? Now, tell me what is levered beta? 1 point. Before that I forgot what the debt equity ratio, right in the term D is to E is equal to what? 1.5 is to 1. Like this you write, otherwise you will make a mistake. Okay, 1.5 is to 1. Debt equity is 1.5 is to 1. Okay. 1.3 into, all do along with me, 1.3 into what? Equity by 1 divided by debt into 1 minus t. 1.5 into 1 minus 0.3. 1.5 into 1 minus 0.3 plus what? 1. 1 by equity by Debt into 1 minus t. 1.5 into 1 minus 0.3 plus 1. Somebody can you simplify and tell me what's the number here? 0.639 times. 0.639 times. Now number solli. Auction my don't tell me 0.634. 0.634. So the beta of asset is equal to 0.634. This 0.634 represents what risk? Only the asset risk. This is called a source beta, so no. Why this 0.634 beta becomes something in a 1.3? Because of what? Use of debt. Very simple. When market return changes by 1%, this company return changes by 0.63% if the company is unlevered company. This is a source beta. Okay, when the market changes by 1%, the company changes by 1%, 0.63%. But it is now changing by what? 1.3. Not because of the businesses, because of what? Financial. Because due to use of debt, interest will not increase or decrease with the market change. Yes or no? In that case, the beta gets what? Magnified into 1.3 times now. In a parallel following or not? Now, this is the answer for the first part of the question. Can I question or not? Now, 30th question is over. Take question number 31. Please take question number 31. Omega's company's equity beta 1.4. Please. Risk-free rate is 8% and market risk premium is 7%. I want to know what is 7%. Everybody, what is 7%? RM minus RF. Omega's debt equity ratio is 0.8:1. The pre-tax cost of debt is 12%. If the tax rate is 35%, what is WACC? This is nothing about levered, unlevered. Straight ahead to calculate what? WACC. After using KE. Can I proceed or not? Write down. Next question number 31. I am doing this because all these are past examinations. Just to get a feel, that's all. Okay, write down. Question number 31. Question number 31. Step 1. Calculation of KE. Step 1. Calculation of KE. Calculation of KE. Okay. Now, don't get irritated. Always write the formula and then substitute. KE is equal to what? RF plus beta into RM minus RF. K is equal to RF plus beta into RM minus RF. Now, what is the risk-free rate given here? 8%. 8% plus what is beta of this Omega company? It is 1.4. I want to understand, is this 1.4 levered beta or unlevered beta? Levered beta. The company which is borrowing, it should be obviously a levered beta. Am I right or not? Now, if you are shareholder of a borrowed company, it is what beta? Levered beta. Obviously, it is 1.4 into what is RM minus RF? 7%. 1.4 into some. What is the number here? 17.8%. K is equal to 17.8%. Tell me what is the next item? WACC. Weighted average cost of capital. Now, just to not to make a mistake, tell me what is the debt equity mix they are given here? 0.8:0.1. And right here, debt is to equity is equal to 0.8:1. Other words, what is the total capital? 1.8 is the total capital. Debt is what? 0.8 by 1.8. Equity is what? 1 by 1.8. I just wrote like this because you may mistakenly write in proportion 0.8 and 1. Are you following what I am saying? It is not 0.8 and 1. The proportion is what? 0.8 by 1.8 and 1 by 1.8. Any appunjida? Yes or no? No. Write down. Next. Write the WACC column. What are the columns here? Source. Second column is what? Proportion. Third column is cost. Last column is weighted cost. Source, proportion, cost, and then weighted cost. Can tell me the two sources of finance? Equity and then debt. Now, equity is 1 out of what? 1.8. Another total capital is 1.8. Now, ரொம்ப simple example. 1:1. If I write, what proportion of equity? 1 by 2. What is the proportion of debt here? 1 by 2. Same way. What is the proportion of equity? What is that here? 1 divided by 1.8. We can have it like that here, not an issue. What is the proportion of debt? 0.8 divided by 1.8. Easy to multiply the fraction, 1 by 1.8 and 0 by 1.8. Okay. Now what is the cost of equity found out? 17.8%. Debt cost is, I think, 12% pre-tax. Yes. And what is the tax rate given? 35%. 12% into 1 minus 0.35. Now tell me what is the number here? 7.8%. 7.8%. 17.8 into 1 by 1.8. Tell me what is the weighted cost? 1%? 9.7? 9.7 na 8 above. 9.89%. Next, 7.8 into 0.8 by 1.8. Number? 1%? 3.47%. Tell me the total here. 13.36%. So the WACC is 13.36%. The WACC is 13.36%. Stop talking. Everybody following or not? Now. With this we complete question number 31. Can I go to question number 32 or not? Now. Take question 32. A project has an equity beta of 1.2, please, and was going to be financed by a combination of 30% debt and 70% equity. Assuming debt beta to be 0, calculate the project's required return. Does have one number, that is required return. Calculate the project's required return, taking risk-free rate to be 10% and return on market portfolio to be 8%. Are you following? No. No. Are you yes or no? Okay. I have a doubt. Don't just write like a dictation, like a notes, law notes, auditing notes. Yeah, we are discussing a problem, right or not? Are you getting into the mode of the question or not? No. Any new question, read with intent, read with interest. Sir will read, then Sir will explain. Then don't do like that. Put your mind and what? Read it. Okay. Now, see. Once again I say, first of all, we are going to start a project. We are going to start a what? Project. Tell me, what is the debt equity ratio of the project? 0.3 is to what? 0.7. The project's equity beta is what? 1.2. Now, since the project is having a debt financing, the equity beta of the project can be called as what beta? Levered beta. Ennappa, right or not? Now, next issue is, the debt beta can be assumed to be what? 0. That is already known. Okay. Now the question is, calculate the project's required return. Tell me, what is required return of a project? What is required return of a project? It is the WACC. Because any project, the minimum return I should get is what the investor expects. The project should earn for the debt providers KD, the equity shareholders KE, overall should be earning what? KO or WACC. Always the word cost of capital, IPC's definition, what is cost of capital? It is the minimum return the company should earn for its investors. Yes or no? Or it is a required return or the hurdle rate the company should be earning. Right or not? So whenever they use the word required return, all equity company required return is what? KE. Company having debt means it's going to be what? WACC will be the required rate of return. Everybody following or not? Now, simply the problem asks you to calculate what? WACC. Now, my question is, should I do it? Give it as homework. Same as the previous sum. First calculate what? KE. You tell, you need not write. What is KE? KE is equal to what? RF plus beta into RM minus RM. What is RF? 10%. Plus what is beta? 1.2. Into what minus what? 10 minus 8. He is going to... Oh, sorry. RM minus RF is what? 8%. Sorry. 10 plus 1.2 into 8. He is going to give you KE. Yes or no? Now I have KE. The cost of debt is given as how much percent? 10%. Nothing amiss is what? 10%. And then you have to calculate the WACC calculation, source, proportion, cost, and then weighted cost. The source of what and what? Equity and debt. The proportion of equity is 0.7. The proportion of debt is what? 0.3. We have calculated KE using what? The SML equation. KD is equal to 10 into 1 minus tax rate given or not given? Okay, so the KD is equal to what? 10. Multiple will be getting the WACC. Can I proceed or not? If you want, I will do it or I can proceed. Okay, those who want to do it, raise your hand. Okay, I have not seen any hand. Okay. Number? Okay, sorry. Make a small change here. Make it as, it is a typing mistake. 18%. RM is how much percent? 18%. Sorry. Return on market portfolio given. It is given as how much percent? 18%. It cannot be less than risk-free return here. Then the efficiency front it becomes what? Risk-free asset. It won't come into picture. Understand not? Now, make a stand. It is going to be how much percent? 18%. You know, change money now. Really, can you leave this as homework for you or not? No. So, 32 has been over. Take question number 33. This is the last sum. Please. Shh. Company D has a beta value of 1.2. Stop talking, please. Company has a beta of 1.2. It is thinking of undertaking a project with a beta of 1.7. If when accepted, the project will comprise 10% of firm's total worth. What will be the subsequent beta value of the company? Okay, now. Read the question. I'll just give you 1 minute time. Read the question. Can I proceed? Now, beta of this company is what? 1.2. Beta represents risk. Okay. Now, beta of a company itself is nothing but a portfolio beta. Very simple. I already explained this. I am an investor. I invest in a company doing a banking business. I invest in another company doing an IT business. Okay. In that case, I am said to be holding a portfolio of shares or not? My beta is what beta? Portfolio beta. Can I present not? Same way, a company can invest in one project, which may be banking, maybe investing in what? Another project, it may be what? IT. That's an extreme example I am giving. In that case, the company is a portfolio of project. What a company? Company is nothing but what? Portfolio of projects. Every project has got a unique risk. Yes or no? That means each project will be having a beta and the company is nothing but what? A portfolio of betas. Enough right or not? So now the question is, at present, the current business, they are having a beta how many times? 1.2 times. Now they are going to take up a new project. They are going to take what? New project with the same businesses, on different businesses, different businesses. What is the beta of the new project? 1.7. That means now they are having two portfolios. One is what? Existing projects. Another is what? New project. Existing project beta is 1.2. New project beta is what? 1.7. Now tell me the beta of the company is existing project beta or new beta or portfolio beta? Portfolio beta. What is beta of a portfolio? Weighted average beta of the individual securities inside that portfolio. Ennappa, right or not? And the proportion is the current business is constituting 90% of the wealth and new business constitute 10% of the wealth. Can't we calculate the portfolio beta or not? Right now. Next question number 33. Question number 33. Point number 1. Company is nothing but Company is nothing but portfolio of projects. A company is nothing but portfolio of projects. A company is nothing but portfolio of projects. Point number 2. Each project will have its own beta. Each project will have its own beta. Each project will have its own beta. And the beta of the company is, fill in the blanks, the beta of the company is what beta? Portfolio beta. And the beta of the company is portfolio beta. And the beta of the company is portfolio beta. Can I proceed or not? Next, point number 2 or 3? 3. This company D has now 2 projects. This company D has now 2 projects, namely existing with 1.2 beta, and new with a beta of 1.7. New with a beta of 1.7. The revised beta value of the company is as follows. The revised beta value of the company is as follows. The revised beta value of the company is as follows. The revised beta value of the company is as follows. Can I proceed? Now tell me the columns here. First column is what? Project. Normally you have securities now. Here you have what? Projects. Second column is what? Proportion. Third column is beta. Fourth column is weighted beta. Project, proportion, beta, and then weighted beta. Tell me the 2 projects of the company existing. And the next is what? New project. What is the proportion of existing project? 0.9, and new is going to be 0.1. It is 1.21 and this is 1.7. 0.9 into 1.2 gives you 1.08 and this gives you 0.17. Tell me beta of portfolio is equal to how much? 1.25. Beta of portfolio is equal to 1.25. Now tell me why this company beta has increased? Because in its portfolio it is adding a security, it is adding a project. It is having what? Higher beta. Since I add a risky project into the company's portfolio of projects, then naturally the company should what? Increase. Okay. Now, suppose the company further borrows. The company further what? Borrows. This 1.25 further increases or not? Yes. It increases through what? The leverage aspect. Right or not? So what the companies normally will do is, they will calculate the unlevered beta of every project and find out the unlevered portfolio beta called as asset beta, asset side beta. So no? No. Then what they do? They leverage through their capital structure to get the full risk of the company. Right or not? So this is regarding the solution to question number 33. Now with this we have completed this particular slot called as levered beta, unlevered beta, and then proxy beta. Can you move to the next stage or not? Now see. Just to take stock of what has been discussed, please. We have done from question number 1, 2, 3, 4, 5, 6, 7 has to be done, right or not? We'll do it at the end of the chapter. 8, 9, 10 done or not? 11, 12, 13, 14, 15, 16, 17 I'll give it as homework. It is there in the study material. Also I think last examination question also I give it as homework. 18 over, 19 has been completed. Right or not? Then I think we completed 20, 21, 22, 23, 24 over. Then we completed from what? 30 to what? Question number 38. In this one sum, question number 38 alone is given as what? Homework. These are all the areas we have completed in this chapter till now. Can I proceed or not? No. Stop talking. Yes or no? No. See. We are now doing the chapter portfolio management. We are going to announce it. Okay, after break, they give the movie name and like that we are doing the chapter portfolio management. A long story we are doing. In that, we have completed risk return profile, Markowitz theory. From there we did CML, CAL, and then moved into CAPM, where we discussed about SML. In CAPM we discussed about beta calculation, we discussed about underpricing, overpricing, the portfolio beta, levered, unlevered beta, as well as portfolio betas are all the issues we discussed in the capital asset pricing model. Respond, yes or no? The next issue I have to discuss is called as short single index model and followed by arbitrage pricing theory. See, just sharp single index model, since people I think have not come back from their holiday celebration. Now, yesterday also, say accounts and tax law, there was a lot of absentees. That is why I did not have the class on Tuesday. I did not keep the class on Tuesday. Sunday I kept the costing AMA class just to ensure the students will be present during what sharp single index model. You are taking me for a ride here. See, that is Tuesday leave. Yesterday, Wednesday also, if people have come back from their hometowns, today we could have started sharp single index model. Now, see, probably I don't want to start sharp single index model today because I am doing only for the students. If I can start today, complete today, no problem. Okay, I'll start and complete. I don't worry about that. It will be taking another 2.5 classes to complete the sharp single index model. So what I do is, today I will just stop here regarding the portfolio management. I'll continue with the sharp single index model in the next class. Class I am not leaving, okay. I don't have so much luxury here, okay. Now, what I will do is, why you are shouting? For not doing sharp, not leaving you. Now, what I will do is, we'll do one small area in capital budgeting. All this may be to some extent known to you in the IPC's level also. We'll be doing an area called as live display. There are a lot of small issues in the capital budgeting to be completed, like inflation, capital budgeting, base case NPV, adjusted NPV, live disparity and so on. In the first slot, in which as a filler, I'll complete now the area called as live disparity, where you would have done normal sums in IPCC. We'll be doing some unique life disparity problems in the final level. We'll have that particular slot completed. Anyhow, we have to do that on some day. I'll use it today for what? Completing it. We'll continue with the sharp index model in the next class. Okay. I want to, next class, I think they'll come back or not. They should come back, otherwise I'd have no other option. Can I proceed? Now.
Thank you friends. OMSAI Bhojanapalli.